Good afternoon, students. Today's our topic is ratio analysis. Ratio analysis is a method or process by which the relationship of items or groups of items in the financial statements are computed and presented. Well, various methods and techniques are used in analysis of financial statements, and the ratio analysis is one of the powerful techniques for this purpose. Secondly, you can say it is used to interpret the financial statements so that the strength and weaknesses of a firm, its historical performance, and current financial conditions can be determined. A ratio is an arithmetical expression, students, of relationship between two related and interdependent items. So we can say the term accounting ratio is used to describe the significant relationship which exists between figures shown in a balance sheet, in a profit and loss account, in a budgetary control system, or in any part of the accountant organization. Well, if we define the ratio, then simply, as I say, that the meaning of ratio is the concept which is explained with reference to the items shown in financial statements. Okay, that it is called the accounting ratios. Or you can say when we expresses a magnitude by which one quantity is a multiple or a part of another similar quantity. This is the concept of ratio. The forms or expressions of ratios could be simple or pure ratio in percentage, or we can express the ratios in rate or time also. Now, the words of caution says the ratio is not an end in itself. They are only a means to get to know the financial position of the enterprise. Computing ratio does not add any information to the available figures. It only reveals the relationship in a more meaningful ways so as to enable us to draw conclusions therefrom. Well, ratio analysis is a technique of analysis, comparison, and interpretation of financial statements. It is a process through which various ratios are calculated, and on that basic conclusions are drawn, which become the base of managerial decisions. What we have to do, we have to select the relevant data, we have to calculate the ratios, then after calculation we have to compare with the ratios of the same firm in the past or the ratios of other firms or with the ideal standards of relevant ratios. And finally, interpretation of ratios. That means in the end, conclusions are drawn on the basis of study and comparison of ratios. Now, what is the utility of ratios? Accounting ratios are very useful in assessing the financial position and profitability of an enterprise. However, its utility lies in comparison of the ratios. Well, when we talk about the objectives or importance of ratio analysis, it is very much useful in simplify the accounting figures. Also useful in financial position analysis, or you can say useful in assessing the operational efficiency to assign the efficiency, profitability, and performance of the firm. Now, if we continue the utility of ratio, students, then we can say comparison can be studied for the same enterprise over a number of years. We can use the ratios for two enterprise in the same industry, for one enterprise against the industry as a whole, for one enterprise against a predetermined standard, and for inter-segment comparison within the same organization. So the in nutshell, the use of ratio, it is very much helpful in financial forecasting and planning, useful in locating the weak spots of the business, useful in comparative studies, helpful in communication and coordination, and also useful in control. Thus, we can say that the area and the advantages of the ratio analysis is wider. Now, let's take the second slide, which highlights the classification of ratios. Ratios can be broadly classified into four groups, namely liquidity, capital structure or leverage ratios, profitability ratios, and activity ratios. Now we will see one by one the meaning, uses, and advantages of these ratios. First of all, the liquidity ratio. These ratio analyze the short-term financial position of the firm and indicate the ability of the firm to meet such short-term commitments. Short-term commitment means, students, that how quickly the company is able to pay the current liabilities out of its short-term resources, or you can say current assets. These are also known, the liquidity ratio is also called the solvency ratios. Okay, and when we classified the liquidity ratio, the ratios which indicate the liquidity of a firms could be classified into two parts, that is basically the current ratio or the liquidity ratio, also called the quick ratio or the acid test ratio. So liquidity refers to the ability of a concern to meet its current obligations and when they become due. Secondly, it is essential for smooth conduct of business activities, because if a concern has a poor liquidity position, it may not be able to make timely payments to the creditors and in effect will not be in a position to purchase goods or services on favorable terms. Liquidity ratio measures the short-term solvency, and for this purpose, current ratio, liquid ratios are being studied. So in our next chapter, we will discuss about these two important ratios. That's all.